Another week in the books. And this one ended with a signal that felt earned. Welcome to the VIXShield Daily Market Summary, Market Close Recap for Friday, April 17th, 2026. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. Today we close out the week with a place signal, a VIX that finally pulled back in a meaningful way, and a market that gave options traders something real to work with. We'll walk through the full picture, what the numbers said, what the headlines meant, and what the week's arc looked like from Monday to Friday. Let's get into it. The S&P 500 closed today at 7,126. That is a solid session, up roughly 1.2% on the day. If you've been watching this market all week, that close matters. It's not just a number, it's confirmation that the index held its footing and pushed higher into the weekend. The CBOE Volatility Index, the VIX, settled at 17.48. Yesterday it was sitting at 19.12. That's a drop of 1.64 points, or about 8.5% in a single session. That kind of single-day VIX compression is notable. It tells us that the fear premium the market was carrying yesterday got released today as equities climbed. Now the 5-day moving average on the VIX is sitting at 18.53. Today's reading of 17.48 is about 5.5% below that average. When the VIX trades below its own recent average and continues to compress, that's a bullish signal for premium sellers. It means the market is calming, not heating up. The term structure, the relationship between near-term and longer-dated volatility, is in what we call strong contango. Let me explain that simply. Contango means that volatility expected 3 months from now is priced higher than volatility expected right now. The 3-month VIX measure, known as the VXV, came in at 20.54 today. The spot VIX is at 17.48. That's a spread of just over 3 points. In plain language, the market sees near-term calm, with some uncertainty priced further out. For income traders, that's a favorable setup. Realized volatility, what the market actually did over the last 10 trading days, came in at 12%. Implied volatility, as measured by the VIX, is running at 17.5. That gap between what the market is doing and what options are pricing is where premium sellers earn their edge. Today that gap was open and meaningful. On the broader market canvas, gold added nearly 2.9% today, continuing its run as a safe haven destination. Crude oil, on the other hand, dropped sharply, down over 16%. That kind of move in crude is not a rounding error. It signals real demand concerns or supply-side pressures that bear watching. Bitcoin climbed over 4%, and Ethereum added 2.5%. The crypto complex, moving higher alongside equities, suggests a risk-on tone was broadly in place today, not just in stocks, but across asset classes. The dollar, measured by the DXY, slipped about 0.2%, a modest move, but dollar weakness generally provides a tailwind for equities and commodities alike. Today's cross-asset picture, taken together, leaned risk-on. Now, the headlines that shaped this week's final session. Seeking Alpha ran a piece today titled, "This Rally Won't End Well." It's the kind of headline that gets clicks, and honestly, it reflects a real tension in this market. The S&P is at 7,126. That's a level that would have seemed remarkable not long ago. The bears aren't wrong to ask questions, but markets can stay elevated longer than skeptics expect, and the volatility structure today is not screaming danger. It's whispering caution. There's a difference. And behind that headline, we have MarketWatch flagging something every options trader should have circled on the calendar. Tesla, IBM, and Intel all report earnings next week. Three major names, three potential volatility events. When large cap tech and industrial bellwethers report in the same week, implied volatility tends to rise in the days before those announcements. That's not a prediction, it's a pattern, worth watching as we head into next week. Which brings me to the Fed. Two Federal Reserve officials, Governor Waller and President Barkin, are scheduled to speak. Fed commentary has a way of reshaping rate expectations quickly, and rate expectations move the VIX. If either speaker signals a shift in the Fed's posture, more hawkish, more dovish, or simply more uncertain, you could see volatility reprice in a hurry. These are the kinds of events that can change everything in the span of a press release. Meanwhile, CBOE reported record daily proprietary index options volume. Let that land for a moment. Record volume in index options means more participants, more hedging activity, more premium changing hands. For a strategy built around selling that premium systematically, a growing and liquid market is a structural tailwind. Taken together, today's headlines told the story of a market that is climbing cautiously, aware of the risks ahead, watching the Fed, and pricing in uncertainty around next week's earnings calendar. The VIX drop today was real, but it didn't happen in a vacuum. It happened because equities rallied and short-term fear eased. The longer-dated uncertainty, that 3-point contango spread, tells you the market hasn't forgotten what's coming. Let's look beneath the surface at volatility now and what it meant for our entry framework today. The VIX at 17.48 puts us in what we call the caution zone, between 15 and 20. Not alarming, but not fully relaxed either. The 5-day moving average at 18.53 confirms the directional trend. Volatility is declining. That's the signal we want to see when evaluating whether conditions are right for an iron condor entry. The expected daily range indicator, our EDR, came in at 1.38%. Our entry gate requires that number to be below 1.5%. It cleared that threshold with room to spare. The EDR gate met. The VIX gate met. Both conditions satisfied. The historical volatility over the last 10 trading days, 12%, is running well below the implied volatility reading. That gap is the premium seller's friend. When the market is implying more volatility than it's actually delivering, selling options premium has a structural edge. Today that edge was present. The EDR temporal reading, a measure of how much daily range potential is priced into the options market on a forward basis, came in at just over 8%. That's well above the threshold of less than 1% required to trigger a forward roll recommendation. More on that in a moment. Now, the strategy insight for today. The VIXShield place signal was confirmed for Friday, April 17th. Let me walk through what had to be true for that signal to fire, because on a week like this one, it feels earned. VIX at 17.48, elevated but still below 20. Conservative tier is green, safe to place. Balanced is yellow, tradable, but size down if you are cautious. Aggressive is red today, blocked per our VIX rules. We do not push the aggressive button when volatility is running this hot. The place signal is confirmed. For the conservative tier, the structure we look at is an iron condor with the put spread anchored at 68, 95, and 6900 on the downside, and the call spread at 71.80 and 71.85 on the upside. Net credit, 65 cents. Maximum loss, $435. Risk to reward ratio, 6.7 to 1. That's the conservative structure. Wider wings, lower credit, more room for the market to move. The balanced tier tightens things up. Put spread at 69.25 and 69.30. Call spread at 71.50 and 71.55. Net credit, $1.10. Maximum loss, $390. Risk to reward, 3.5 to 1. More premium collected, less buffer. That's why it carries the yellow designation today. The aggressive tier is inactive. The VIX rules block it above 15, and we respect that. Discipline isn't just for losing days. Now, the theta time shift indicator is pointing to a forward roll today. The EDR temporal reading of just over 8%, combined with a VIX above 16, triggers what we call the forward roll mode. In plain language, conditions favor extending your trade duration to around 7 days to expiration. The reason is vega capture, the potential to collect an additional 45 to 80 cents per contract by giving the trade more time to work in a declining volatility environment. When volatility is falling and the term structure is in contango, time is your ally. On the protection side, the ALVH framework, our layered hedge system, has 2 of 3 layers active today. The short-term spike guard and the medium-term wave shield are both running. The long-term endurance hedge is not active in this environment. That's appropriate for a contango regime. The annual cost of maintaining these hedges runs roughly 1 to 2% of account value, and historically that kind of protection has offset 30 to 50% of iron Condor losses during sharp 10% plus market drops. Insurance you hope you never need, but are grateful to carry. Now, the discipline lesson and a look at the week as a whole. This week had a clear narrative arc. Early in the week, the VIX was running above 19. Volatility was elevated. The caution flags were up. As the week progressed, equities found their footing, and by Friday, the VIX had compressed to 17.5, below its 5-day average, with the term structure firmly in contango. The market's fear gauge did what it often does after a period of uncertainty. It exhaled. The discipline lesson from this week is straightforward. When conditions are not fully green, you do not force the trade. You wait. You size down. You respect the tier rules. The aggressive tier was blocked all week, and that was the right call. Markets that feel volatile often are volatile, even when the index is climbing. Here is your weekly scorecard. Based on the signals this week, we saw the place conditions met today, Friday, with the conservative and balanced tiers active. Earlier in the week, elevated VIX readings above 19 kept conditions more restricted. If you held discipline through the tighter days and executed on the confirmed place signal today, that's exactly how the system is designed to work. Heading into the weekend, here's what to monitor. Fed speakers Waller and Barkin could move the tape with any commentary on rates or the economic outlook. Overnight futures Sunday evening will be the first read on how the market digests the weekend news flow. Earnings from Tesla, IBM, and Intel loom large next week. Implied volatility will likely begin building in those names by Monday, and crude oil's sharp decline bears watching. A 16% drop in a single session is a signal, not noise. If you found today's summary valuable, share it with a friend. Both of you will receive 14 extra days of free trial access to the full VIXShield podcast and signals. Your personal share link is waiting for you in your member dashboard. This market summary is brought to you by VIXShield, your protection against daily uncertainty. And with that, we close the books on another trading week. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of